Hello and welcome. Coming up in today's stock analysis video, we are going to examine ResMed. During our stock analysis, we are going to explore the key pillars, examine the ownership, look back at past results. We also want to find out what analysts' predictions are, as well as giving the business a valuation, and examine the potential return on our investment, and finally draw some conclusions based on our findings. This is Bitesize Investments, giving you a step-by-step approach to your investment journey. Before we jump into the key pillars, let's just find out the latest news headlines for the company ResMed. ResMed provides continuous positive airway pressure machines that help manage sleep apnea. It's a condition where the airway gets blocked many times during sleep. ResMed beat Wall Street estimates for second quarter revenue and profit, powered by strong demand for its respiratory devices used to treat sleep apnea. Adjusted profit of $1.88 per share beats analysts' average estimate of $1.80, while revenue of $1.2 billion topped estimates of $1.15 billion. ResMed said its respiratory mask containing magnets will remain on the market, even though the US Food and Drug Administration called for a recall of the product, stating it as a serious concern as its current problem could cause major injuries or even death. ResMed's masks are safe to be used at kept at a distance of 6 inches away from implants or medical devices that may be adversely affected by magnetic interference. ResMed announced it had secured a significant victory after the United States Patent Trial and Appeals Board invalidated the claims. In rulings issued in December 2023, the judges agreed with ResMed's arguments and found that all claims across the 7 patents were invalid. Let's start by looking at the key pillars of the trailing 12 months. Within the first pillar, we want to explore the return, which helps indicate how good the management of the business is. So we'll look at the return on invested capital, which is a calculation used to assess the company's efficiency at allocating capital under its control. And we also want to look at the return on equity, which is a measure of the financial performance calculated by dividing the net income by the shareholders' equity. Return on invested capital is 15% and return on equity is 20%, and we would like to see both of these above 10%, so that's a tick for ResMed's management. And this indicates that the company is working very effectively. Now we're going to look at the free cash flow yield, which is a financial ratio that compares the free cash flow per share of a company against its market value per share. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability than traditional earnings or dividend yields. It's based on the actual cash a business generates rather than reported earnings, which may be subject to various accounting adjustments. He typically looks for a company that has a free cash flow yield of 5% or higher. So at 2.71%, this is a little lower than we would like, but is still fairly healthy. Now let's look at the gross margin, which is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. This is 55%, so it's pretty decent, but looking back at the historical average, this is a little bit down on previous years. Next we come to the operating profit margin. This tells us how much profit a company makes on $1 of sales after paying for costs of production, such as wages and raw materials, but before paying any interest or tax. ResMed's operating profit margin is 30%, which is pretty incredible as it's double the ideal rate of 15%. Now we move on to debt, and Phil Town prefers a company that is able to pay off debt with their free cash flow within 3 years. In ResMed's case, this is excellent as it's 1.81. Lastly, we're going to look at short selling and see if any traders are expecting the share price to drop. So anything that is over 5% we would tend to avoid until the volatility has settled. At 4.64%, this suggests traders are getting pretty confident in their ability to short the stock. So it's a little bit of a warning sign that we could be expecting to see the stock price to dip. Let's take a closer look at ResMed's free cash flow, and we can see this has been very inconsistent. The free cash flow is currently the highest it's ever been, but with every high there seems to be a dip the following year. ResMed has a large market cap and Morningstar believe that they have a narrow moat, even though they currently own about 44% of the market and their biggest rival is Philips. Now let's look at the ownership. There are currently 2 super investors who own this company, however 6 more had previously owned this stock. If we look back at Ken Fisher's previous purchases, we can see he has repeatedly bought and sold ResMed shares and recently sold 46,000 shares, then only to buy 3,000 shares back in the last quarter. Then if we look at Paul Tudor Jones II, which he has a very British sounding name I must add, again we can see he has consistently bought and sold ResMed shares and has recently purchased 124,000 shares in the last quarter. And finally, Ray Dalio recently sold out of his stake in ResMed in the last quarter, but is another investor who has consistently bought and sold the company previously. Now we look at the past historical prices of the company, as this will help us build a picture of periods of success or failure the business has been through. As we can see, the share price was happily going up year on year. However, since 2022, the average share price has slowly been creeping downwards and fell dramatically to $132 a share when Novo Nordisk released its weight loss drug last year, but has since recovered to about $192 per share. Only time will tell if this year continues the trend of a falling share price. So let's see what the analysts think. A number of analysts believe that ResMed is still undervalued, although some think the share price is about right at the moment. The general consensus is that ResMed is still a buy based on the company's financial health, dividend and present share value. Now, in order to build a valuation, we need to look back at the past, but also decide on a possible future for the company. Let's look back for the trailing 12 months and see what insight this gives us. The PE ratio is 31.93. Its EPS is 6.01, which is down by 2% from last year. Free cash flow per share is 5.20, which is up 34% since last year. Revenue is 30.41, up 6%. Book value per share is 30.34, up 8%, and equity growth over the 10 years average is about 12%. Let's add some context to the revenue by looking back over the last 10 years. The year-on-year improvement is really impressive and has consistently made revenue gains for the last 10 years. If we look at the revenue and expenses chart, we can see that 88% of the revenue brought in is for the sleep and respiratory devices, and just 12% is for the sleep apnea software. Gross profit is slightly more than double its cost of sales, and this is definitely the reason why the operating profits are as high as 30%. Here we can see that ResMed's earnings per share has always been consistently over $2 per share, and it's particularly good at the moment at 6.01, but is slightly down on the amazing 6.12 earnings per share from last year. For the last 5 years, the book value per share has been excellent and has nicely increased year on year. This represents superb value for its shareholders. Next, we need to decide which type of valuation will be best suited for this company. A discounted free cash flow to the firm, a dividend discount model, or an earnings per share growth model. For this particular company, I'm going to use a discounted free cash flow to the firm model. This is where you use historical financial information and project forward to give you the terminal value. So in this case, I'll collect the total revenue for the trailing 12 months and look back at the 5-year average growth and project this forward 5 years. I did this for the total revenue, net income and free cash flow. I then included a discount factor. Then you work out the present value of the future cash flows, which you use to work out today's value and divide this by the shares outstanding to give you a fair value of equity, which is $229. And then you use this number to work out the present sticker value, which is $114. There are a few details I've skipped over in this section just for the sake of simplicity. However, if we add a margin of safety of about 50%, it reduces this price down even further to $57 per share. At this point, with such a discrepancy between the current share price and the sticker price, I would look at other models to see if there's something I've missed. Interestingly, in this case, if I look at the 52-week low, it was $132. But during the market bottom of the pandemic, ResMed hit the low of $114 per share. And prior to the market dip, it was trading at $168 per share. With this in mind, I think it's more likely that the $114 per share is the margin of safety, and the sticker price is probably more like $220 per share. In this next section, we're going to split the chart into different zones, and our first zone is what we look back at being the market bottom for ResMed, which was about $114, and represents our 50% margin of safety. After that, we identify zone 2, which is possibly about $135 based on the 52-week low from last year. We currently seem to be within zone 3 now, which is about $180. And finally, zone 4 is what we identified as our exit strategy, or at least the point of where we take some profits off the table, which I think ResMed has the potential to go up to $220 per share. In this next section, we find out what our potential return would be if we bought at today's price of $192 per share. If the share price was to hit the 52-week high of $243, then we would see a return of 27%. Whereas if we hit zone 4 in our exit strategy, we would see a return of about 15%. I personally don't think we'll hit the pandemic highs again, so I think $220 would be more than a realistic price. This is not financial advice, just my personal opinion. ResMed does pay a dividend of $1.76, which is pretty good, and this has seen a growth of 7.69%. The payout is 29%, so the company are not overreaching with its dividend. Finally, let's draw some conclusions about what we found out about the company. Let's start with the positives. The management of the company is very good, and they work hard to ensure shareholders are looked after. Not only that, but they control about 44% of the sleep apnea market and are considered by Morningstar to have a narrow moat. And finally, for every dollar of earning, they create about $6 of value. And now for the negatives. Will dietary pills reduce the number of people suffering from sleep apnea in the future, as a person's weight is a key factor in the condition? And back in February, Peter Farrell, a founder of the business, sold about 24,000 shares, which was worth about $5 million. Does he know something we don't as an insider? And most recently, some devices are recalled by the FDA due to possible magnetic interference, which is a concern as well. What are your thoughts on the company? Is this an opportunity for you to own part of the business, or would you rather wait for a better price? Or would you like to avoid this company altogether? Let me know in the comments section below. Thank you for watching, and I'll see you in the next one.